We hit that 80 to 85 range. And that was where we started people saying like, hey, maybe things are attractive to actually buy the dip now.
What's up, everybody? It's LG Doucette here, and welcome to the Milk Road Show, the daily crypto show that tries to find a trend in a market that wants to go nowhere. Today is November 24th, 2025. We've got David Duong, head of institutional research at Coinbase, back on the show. And since our last episode with him, crypto has not bounced. It has bled. Bitcoin has dipped way below key support bands. The ETF flows have kind of turned a little bit cautious, a little bit of uptick, but not very good. And volatility has gone absolutely crazy. Coinbase research is all over this, although David did recently record a podcast titled No Man's Land in reference to the market, but he claims he is more optimistic than that title suggests. So today, I'm going to grill him on that. I want to know what he's writing about, what they're researching, and honestly, what Coinbase thinks is going on with the market. Before we start, listen, our research team eats, sleeps, and dreams crypto, so you don't have to. Every week, they drop a report on what matters, and last weekend's pro report, well, it was all about the profit AI wave and what's happening with the NVIDIA earnings and how that's going to affect the rest of the market. So if you want to check that out, get that deeper insight, you want that edge, go check it out. It's in the show notes. Milk Road Pro is what you want to be signed up to. And today's episode is brought to you by Bridge. Power your business with instant stablecoin payments, no friction, no banks, just global finance made simple. Blocktrust IRA, let AI outsmart the market and grow your crypto while you sleep. Reserve DTFs, get exposure to the entire crypto market in a single token. David, welcome back, man. Welcome back in these interesting times.
Hey, LG, thanks.
It's good to have you. Listen, we got to go right to it because when I was kind of checking out your last bits of content, I did find a podcast from Coinbase Institutional that was titled No Man's Land. And that was the title of the episode. What do you mean by that in terms of positioning and liquidity and price action? What are you talking about with No Man's Land?
Yeah, so this is now about a week old. And, this market's moving so fast that a lifetime passes over a week. But what we were referring to is the fact that if we're looking at where a lot of the accumulation was done for Bitcoin specifically, it was done around that $98,000 to $100,000 per Bitcoin level. So after we broke that key level, and we've broken several since then, we've broken like that 100,000, we've broken the 90,000 threshold. We were basically saying like it's very unclear where the floor for Bitcoin prices at least really kind of lands, because below here, we're well past the 200-day moving average. We're well past the point where short-term holders, long-term holders all have accumulated their Bitcoin. So I think this is kind of the question mark that a lot of people have. Like, where do we kind of go from here? Are we going to find stability? Is there any clear floor that we can kind of look to?
What are the most important indicators for you? Because on the show we've covered everything, right? And we had like Michael Nato from the DeFi Report last week talking about all these charts and all these pieces about the dollar that to him indicated a potential downturn like 2 months ago. So for you at this point, what are you looking for in terms of what the most important, like maybe technical indicators are or macro indicators? What does that look like for you?
Yeah, number one on my list remains liquidity. And when I say that, a lot of people think about the M2 money supply index. And I don't disagree with that, by the way. I think that M2 money supply is a critical piece of information when I'm trying to figure out where Bitcoin's going. And if you want to understand where like the rest of the market complex is going, i.e. what's going to happen with altcoins, you really do need to first understand what's going to happen with Bitcoin. Now, the problem with that is a lot of people either take the US M2 money supply or they use global money supply and they just kind of overlay it naively with Bitcoin prices or an index of their choice. And I push back against that because that doesn't tell you where liquidity, the pockets of liquidity that really drive the crypto market are really going. And if you look at a more customized global M2 money supply index, which is what we do, and we basically weight the distribution of that liquidity more towards those markets that matter. And, like I think some of your listeners may be aware, for example, like this is traded more heavily in South Korea than it is in India, for example, like things like that. Those kind of decisions matter when you're trying to figure out how to customize this. And then you also have to like figure out how long does it take for that liquidity to actually make its way into markets. And we ran regression analysis. We looked at it at 30, 60, 90 days, et cetera. And basically we found out the highest regression kind of pattern shows that the 110-day lag is optimal for this. Now, I bring this all up because
Mm.
when we saw back in September and October that this was pointing south, we were kind of worried, but we were also saying like, well, it doesn't make sense because the macro factors actually seem very supportive for crypto prices at the moment. We're looking at where things are going as far as, equity prices, the other risk assets, things like that. It seems like, if anything, it should be continuing to move higher. Obviously, like it's played out the way our liquidity index has kind of reflected. And the good news is that that's showing that it's going to inflect higher in December. So there is that downturn. It doesn't tend to be this short-lived, and I think that there are some strange dynamics going on with M1 and M2 money supply out of Asia that I'm happy to kind of talk to. But I think that some of those things are driving some strange dynamics. But the bottom line is it was supposed to come down, at least on a lag basis, in November. But I think that coming into December, and there's a lot of factors that support this, the fact that quantitative tightening is going to end on December 1st. The fact is that I think the markets had it wrong about what the Fed was going to do on December 10th. Of course, now it's probabilities are pricing higher, but I think that those rate cuts are going to come in. So I think all this lines up to actually seeing a potential recovery as we get into December.
David, you said something in there about the, maybe you can clarify this for me, the regression that's 110 days. Can you just expand on that a little bit and kind of circle back and explain it with a little bit more depth?
Yeah. So simple, like linear regression analysis on trying to figure out, okay, what is the right way to lag this? Should I be looking at M2? Like, how long does it take before this liquidity gets into the market? Does it take 5 days as new money comes into the market, as central banks print more cash, whatever? Like, does it take 5 days, 10 days? Like, how long does it take for you to get money out of your pocket and say, like, you know what, I need to like start putting this money in risk because it's doing nothing for me right now? And I brought this up on the show before about like money market funds, for example. They're still around $7.5 trillion worth of capital sitting in money market funds. But what does it take for you to kind of get out of that and move into something else? Because at a certain point, 5% seems okay to get paid, but 4%, maybe a little bit less so, 3%, a lot less attractive. By the time you get to around 2%, you're like, well, crap, I'm not even getting enough to cover myself for inflation. I can't be in just money market funds anymore. I can't just be in cash. I need to be buying equities. I need to be buying crypto. I need to be buying something that gives me a higher return to compensate me for that. So how many days does it take for me to get from point A to point B? And I do not have the nuances of like what motivates people like from a behavioral perspective to like actually get from point A to point B. But what I can tell you is that when we run a regression analysis to say how long should that be, generally it seems that the highest correlation coefficient we get is associated with 110 days. So around that 110-day mark, that's the point at which people actually start to move that capital. And you see that reflected in the prices of a lot of these risk assets, i.e. Bitcoin.
And when you say people, who do you mean?
So it's pretty broad because M2 is a broad money indicator. So it does include both institutions as well as retail. I cannot give you more information on that because I don't have it. But I do think that this speaks to not just people at the corporate or like money manager level, but also you and I. Like, I think that this is kind of like very, very broad based. So people who would deploy that into ETFs, or who would potentially buy Bitcoin or whatever other crypto asset natively, like on an exchange. So I think that we do not have the full information on what that is, but we can say that like this affects probably the largest kind of opportunity set that we get in our economy.
Okay. So is it retail participants looking at that, or is it more institution? I guess that's kind of more what I was asking, right? Because maybe it is. You're saying maybe it's not people like you and I, but even these terms I'm saying is it's not really something that retail is as aware of, right? So I'm just trying to figure out who is it that's making those moves and kind of waiting for that.
Yeah, I'm starting to lose touch with like who's looking at this and who's not. I mean, once upon a time, I thought that a lot of retail people do not give them credit for, because I think that oftentimes people assume that retail is broadly naive money, whereas institutional is smart money. And I don't think those terms apply anymore. I do think that there are a lot of retail players who actually look at some of these indicators. Maybe they don't have a Bloomberg terminal. Maybe they're looking at it on some other platform. But certainly, I think that these things are a lot more accessible than they were previously. AI is probably responsible for a lot of that as well.
What is a metric then, David? We're talking about things that you do look at. What's something that you see on the timeline or you see from Coinbase customers or from podcasters like me? What is something that people are hung up on in the last 6 weeks that you think is completely irrelevant to what's actually happening?
100%. A lot of people are hung up on the 4-year cycle. Do I think that's not relevant? No, I do think that it's relevant to an extent, but I think people give it a lot more credit than it actually deserves. Certainly, what we're seeing in terms of ETF outflows, in terms of a lot of digital asset treasuries who are not buying right now and might be actually playing more defensively because they're getting more pressure from their investors, given that MNAVs are compressing. I think those things matter a lot more. And that has a lot to do with the broader risk environment, because you see this in tech names, you see this in quant names on the equity side as well. I would say that a lot of people think that things look overvalued. And this was evident in some of the earnings releases that we got from Meta, Microsoft, places like that, where previously they were rewarded for taking additional CapEx, and after the last earnings report, they were punished for it because a lot of people do not believe that the return on their investment looks as attractive as it once did. So I think these things are what's really driving the markets. Whereas the 4-year cycle, I think that it's relevant from a psychological perspective. Obviously, there's a lot of people in the crypto space who are used to it. We don't have a ton of evidence about it, and this is the problem. As a former quant, there's, you have very, very limited statistical evidence of this stuff, barely 15 years, because not all of that data was liquid enough to kind of count towards actually being utilized in that way. But that means you had 3 cycles that you could really think about that were maybe potentially relevant, because, you're taking it from the point of the Bitcoin halving. And that's not a ton to go on. If I said you're dude, 3 times this happened already, it's a sure bet. It's you would be like, David, you're crazy. It's just because it happened 3 times doesn't mean that's gonna always happen. That's just not how life works. But I do think that some of those dynamics have changed. Once upon a time, I would say the Bitcoin miners were a much more relevant, representation of the discretionary selling that gets done in the space. But because of DATs, because of ETFs, they were almost fully absorbed and then some. Now we're kind of coming back the other way, and now because TradFi is more skittish about this stuff, you've seen the outflows from ETFs. You've seen DATs not really participating, not really buying here, and as a result, I think that some of that selling pressure has now come back in a way that we weren't anticipating before.
Stablecoins are the biggest use case in crypto right now, but let's be real, using them on chain is still way too complex. That's exactly the problem Bridge is solving. Recently acquired by Stripe, yep, that's Stripe, Bridge helps businesses send, store, accept, and launch stablecoins instantly. Explore the future of global financial infrastructure at milkroad.com/bridge.
Bitcoin changed the investment game. Now AI changes the strategy. Crypto's wild ride demands perfect timing, selling before drops, buying as it climbs. While most investors panic, sell, or hope, a select few leverage a crucial edge: AI. Blocktrust IRA's trading platform spots market patterns with precision no human can match. Since 2020, their Animus AI platform has outperformed Bitcoin by over 250%. Visit milkroad.com/blocktrust today to get up to $2,500 in bonus crypto and transform your investment strategy. I have one more question about the cycle, because I think it's such a funny thing, but it's almost one of those things where it's until disproven, it almost feels true, even though it's silly in a sense, right? It's happened 3 times. That means it can only ever happen. That can only be the only explanation, right? It doesn't really make sense, but we had this top that now we're far away from, and until we go back to that, how do you disprove it, right? My question for you about that is, let's say, you're painting us an optimistic picture. Let's say we have this bump back up in December and into the new year, we come back up. If Bitcoin never hits another all-time high, like let's say it comes back up to $200 below the current all-time high in Q1, and then floats there for a long time, comes up and down, and then doesn't come back around it doesn't break the all-time high for another 3 years, would you consider that a 4-year cycle?
I mean, if you have to put a label on it, I think that people will do so. Again, I wouldn't. I hesitate to do so because I don't think that it's solely about looking at like where the price, the entry and the exits of these things. And I point this out because we've seen in previous cycles is that like there's so much other factors going into this that we can't really even be sure that it had solely to do with the technical dynamics, i.e. the supply demand dynamics of the halving that really kind of drove those prices higher and lower. Take 2016, 2017, for example, when we had Brexit. Like if you were an investor and you were concerned about, where things were going with that, and I'll admit, like, I think I got Brexit wrong. I didn't think that they would have ever kind of like shot themselves in the foot in that way, but it happened. But if you were looking for protection, or you're looking for ways to kind of diversify yourself because, the sterling is collapsing, then perhaps you would have bought some more Bitcoin. And, we saw other periods of the halving kind of coincide with like US government shutdowns, things like that. I mean, like, there could always, it's hard to do it with backtesting to like get full assurance that this was solely related to just the pure supply dynamics of Bitcoin itself. I mean, that's just that's just finance in a nutshell. I mean, like, it's always hard to disentangle like where the full effects are. But because of that, I just can never be sure that when I'm looking at something like this, I'm not saying it's not a pattern. It's a pattern. It's just not one that I think can be purely justified by just the dynamics internal to Bitcoin itself.
Yeah, that makes sense. David, I want to move on to, I guess maybe some of the more about the stuff that you guys have been writing about. But before we do that, I just want to ask you, I guess, kind of, a question that ties into the fear that we're seeing in the market right now. Is there anything that you would label as potentially giving us another cascade down? Is there anything that you're looking at that's like, if we don't hit this, or we don't stay above this level, or this doesn't happen, like a rate cut, for example, we are going down another 10 or 20%?
Yeah. So, like, we generally are not allowed to talk about price levels at Coinbase, or at least not externally. But I will say that, like, I looked at 90 as a very big psychological level when that dropped. I didn't see a lot of room for people to kind of, buy back in below like, 80, I'm sorry, below that level until we reached somewhere between 80 to 85. And I think that's kind of what we're seeing right now. We hit that 80 to 85 range. And that was where we started people saying like, hey, maybe things are attractive to actually buy the dip now. And I don't mean that to suggest that people should just blindly buy the dip. Like, I mean, quite frankly, like, I think that you really need to wait for high volume reclaims of those key levels. Maybe like a turn in the ETF stablecoin flows before trying to like kind of re-enter here. But again, I do think that conditions look a lot better in December. So already, this is probably why people are starting to look at this and kind of saying like, you know what, maybe like within that 80 to 85 range, things are looking a lot better. Maybe we should kind of incrementally step in here. And I think that's probably true of institutions, who I think are the main players here, but probably some retail players as well. But to your question, what's going to drag us lower? I think that now, if the Fed doesn't cut rates in December, the good news is that for the most part, people were already kind of skittish about that already, and a lot of that concern was priced in. So even if the Fed doesn't deliver that cut, I think that if they come out and their comments suggest that a Fed put could be in play, I think that would be enough to drive a Santa rally. So I'm not necessarily kind of like needing just a cut. Like, I think my cut would be great because then it would validate like what my view is. Like, I had a former boss who used to say like, bull markets do not die of old age. They are slaughtered by the Fed. So This is kind of what we're seeing right now because of the hawkish tone that we saw from Powell at the last meeting, because of the kind of the hawkish tone we got in the minutes, and then the quick reversal, like just on Friday when we saw Williams come in with a very dovish kind of commentary. I think that this is really what's driving the markets and why things have been so chaotic. But given my view is that the Fed is going to continue with rate cuts. Perhaps if it doesn't happen in December, it's going to happen in the first half of 2026. I don't think that we're at the end of like a positive news for the market yet.
What are you going to name this dip? Let's say you're right. This is a good estimation. We bounce back up. In April, we had the tariffs. What is the name of this one?
Yeah, this has been the toughest part, labeling this, because this is a over 3-standard-deviation move in Bitcoin. And just so you appreciate how big that is. I mean, we saw like a 1-standard-deviation move in US equities. So it's still bad, but like 3-standard-deviation moves, the only other times we've seen this, I mean, we've seen this a few times now in our history, but the last few times that we saw it was, as you mentioned, in March 2025 because of the concern around tariffs. We saw this back in November 2022 when FTX blew up. We saw this back in May 2022 when Terra Luna happened. So this is a meaningful move. And a lot of it had to do with the fact that excess leverage just got built up in the system between February and August, because during that period, actually, I'm sorry, like around April through August, over that period of time, we saw that leverage, and I compare this relative to the total crypto market cap, shot up to around 10% of the total crypto market cap. I mean, that's huge. Like back in 2022, this only went as high as like 6%. So we were already like very, very, very like taking a ton of leverage when we're looking at perps, when we're looking at options, derivatives, and that all has come down to around 4%. So we have cleaned up positioning quite spectacularly, meaning that, you know, I was still calling for this to kind of take a few months to kind of clean up. And I think that's still true. But if we're talking at least from a pure positioning perspective, it doesn't seem like there's a lot of longs in the space, and it doesn't necessarily pay to be short anymore. So we're probably in a good place to at least see things kind of forming a bottom here. Again, it's very hard to tell whether we have reached the bottom, but I think that like going forward, I think this is kind of what we're getting at the moment. I think that in the low liquidity environment with the US holidays coming up this week, I think very likely that if we get positive news coming on December 1st and December 10th, coming from the Fed and monetary policy more broadly, I think that this could start to support markets.
So everybody gets a chance to tell their extended families to buy the dip this week. That's 4 years ago they were told to buy the top, and now they get to buy the dip. The same price for Ethereum too.
I never do that. I never do that because I don't want to get myself in trouble. I never do it on anyone's show, and I definitely don't tell my family members to do that.
Wise. That's the sage advice. Yeah, that's the veteran advice right there. Is just don't even say anything to your family. I like that. Okay, David, my next question for you, and this is something we talk about at Milk Road a lot. We even launched a separate channel about AI as a risk asset. Is AI kind of stealing a crypto's thunder a little bit? Like is plowing into this potential AI bubble, is that becoming now the riskier trade than crypto that people have appetite for? I mean,
this is a super interesting question because I think there are two big effects from AI. And the first one's the one you talked about, which is it attracting capital away from crypto or other risk assets? And to an extent, I have to say, yeah. I think that there's definitely something going on in terms of the people who play in crypto are also playing in tech names and AI stocks and quant stocks and other things. And the capital tends to be a lot more fluid now than it used to be there. And I wouldn't necessarily phrase it as, oh, it's stealing crypto's liquidity or it's taking money away from that. But certainly, if we assume liquidity as a finite pool of capital, I think that you have to assume as well that like if things are impacting things on the AI name, i.e. like people saying like, okay, is X name like overvalued? I think that that's also, if your profitability there is getting affected, then it's also going to affect your desire, interest, and our ability to actually play in crypto as well. But the other thing is, I think it's AI more broadly is having an impact on the US economy. And maybe it's probably having an effect on the global economy. And what I mean by this is, I had a colleague who sent me the other day this this news story about Amazon is laying off X number of workers. I don't remember the number anymore. I want to say it was 100,000 or whatever number of
it's
workers.
600,000 or 300,000. Okay. It's just like an ungodly number that you didn't even know Amazon had that kind of staff.
Right. And I mean, there are, of course, people who believe that a lot of that had to do with overhiring during the pandemic and other things, but also is AI playing a factor. The concern about it is that, of course, we were always thinking that AI was going to start displacing jobs. We've seen a lot of that happen on the entry level side of things, but this is now affecting white collar workers, middle management, and those are, what I would say have a lot of the buyers that we have seen for crypto and risk assets more broadly. I think there's a stat out there that say that the top 10% of all Americans actually own 89% of the stocks that are available out there. So it's a crazy stat when you really think about it. But more to the point, I would say, is this creating a K-shaped dynamic in the economy? But K-shaped dynamic, what I mean is, this is not a new concept. This actually came out, I think, during the pandemic. The idea of a K-shaped economy, that you see people on the higher tier really accumulating all the flows, all the benefits of a lot of what we're seeing in terms of the production, the output of the economy. But now, if those buyers, which have definitely contributed towards crypto's rise, if they're getting affected because of layoffs or other things, will we see a detriment to crypto's prospects? Now, I ran a simple kind of regression analysis on there. We don't have enough data to go on, because you think about it, ChatGPT has only been around since November 2022. So we've have 3 years of data. Most of the stuff is monthly data. That's 36 data points. It really doesn't tell you anything in terms of whether it's driving it one way or the other. I think that's the good news. But I would say that increasingly we have to start thinking that a lot of the value of AI is going towards the corporates, i.e. productivity is becoming a lot better. I've talked about it before in the show. I think that this is what's going to support the US economy, because productivity kind of moves in these 15-year cycles. And we've been at the start of one since, 2020, 2021, and it's really starting to pick up steam now. Will this disproportionately, however, impact workers, and not just on the lower end of the spectrum, but on the higher end, your tech names, your people in finance, people who honestly trade crypto stuff? Now, I think that's going to be an open question. I don't have the answer right now. It doesn't seem like it for the time being, which means that my thesis about, the capital sitting in money market funds or sideline capital moving back into the space could still be true. And I think that's going to be true over the next 3 to 6 months. But then we'll have to reassess. We'll have to keep watching whether these things are going to manifest in a way that could be detrimental to risk more broadly.
David, you guys write a fantastic weekly newsletter, a lot of great content coming out of it, Coinbase Institutional. So I recommend everybody here check out, I guess, coinbase.com/institutional. Is that the right website to find the work? Actually,
yes.
Sure.
Right now we're sending all our research out to Coinbase One subscribers and institutional clients 7 days early. But after those 7 days and they get it via email, then it appears on our website.
That's right. Okay. Your latest one, which came out, I think, just on Friday, is titled Weekly, The Age of Anxiety. And in here, you've got a lot of great data that I kind of want you to walk us through. And it kind of recaps a lot of what we talked about today, but I think it's a good way to kind of set us off here. And I think the big summary to me from this is that it really feels like you center on the fact that the market might be mispricing that December Fed meeting. Right. And it felt a little bit like that's kind of what you were focusing on here. But I want to hear from you and want you to kind of walk us through your thoughts in this one.
Yeah, absolutely. And the market has moved so quickly, because when we wrote this on Thursday night and we were even looking at it on Friday morning, markets were still pricing in 22% chance that we would see a 25 basis point rate cut on December 10th. I looked at it this morning, and we are now up to a 75% chance that the Fed will cut rates on December 10th. And I think that change it's no accident that at the same time markets have repriced the possibility of a cut on December 10th, that we're also seeing that we've kind of bounced back on Bitcoin and crypto prices more broadly. And that's why I think we found a little bit of stability here. Again, still a little bit early to kind of call like that, things are completely all clear. But certainly the reason we thought that this was happening is because, one, we're in a data vacuum. We have to acknowledge the fact that we are not ever going to get BLS data, like Bureau of Labor Statistics data. So we will never know what happened in October. But we got some data on September. It wasn't particularly meaningful, in part because it showed a surprise higher on non-farm payrolls, for example, for September. But again, that job print is kind of irrelevant given what the Fed's decision needs to be based on, beyond which they made their 8th revision lower in terms of jobs, and the unemployment data itself presented a pretty mixed picture. But CPI data, I mean, we're going to get some PCE data, I believe, coming out on November 26th. Then we're going to have CPI data that's coming out on December 10th, the same day as the Fed's FOMC meeting. Now, the problem is, how important is this going to be? Because so far, what we've been seeing on the private side of things, and we're looking at nowcasts, we're looking at like Trueflation data, for example, and it's showing, if anything, that the disinflationary trend that we were calling for like months ago is starting to kind of play out. Like things like tariffs, pretty irrelevant. I mean, I've said it on your podcast before, but like now we have a paper coming out from the Federal Reserve Bank of San Francisco saying the same thing. They said, if anything, when we tend to see impacts like tariffs tend to be disinflationary, not inflationary. So I think that if this was the Fed's big concern, I think that if anything, what we're seeing from private statistics, from private data, it's saying that these numbers should actually support a rate cut. So I think that in line with what Federal Reserve Governor Williams said on Friday, and he tends to be on the dovish side compared to like Susan Collins or others who are on the hawkish side, which we heard from the week prior. And we, because we're in a data vacuum, we're just kind of like chasing right now. We're like, oh, she said this, he said that, like let's follow it. But looking at the data, it suggests that a cut should still be coming.
ETFs provide investors with a structured, disciplined, and diversified approach to crypto, which is cool, but the world is moving on chain. We need a crypto-native equivalent. That's exactly what Reserve's decentralized token folios, DTFs, bring to the table. Reserve DTFs are rule-based baskets of crypto assets packaged into a single token, like CoinMarket's CMC20, crypto's version of the S&P 500. Go to milkroad.com/reserve to find out what's on offer. Why is crypto so tied to macro now? That might be the dumbest question I've ever asked, but it's something where I feel like anytime we talk about crypto now, and especially in this current climate, we have to talk about the macro. The only thing we can look at as indicators outside of the general technical analysis, right, is these macro things. Has it always been like that? Or am I just only cluing into that now? Or is this now forever currently the story for this cycle for Bitcoin and crypto?
Macro is definitely dominant right now, but I wouldn't say it's always retains the same level of importance. I would say that it's always important. I always look at macro, but that's also how I trade. And this is kind of why I caution people when they take any advice from any talking head. Like, you need to know what the person's time frame is. What is their trading horizon? My horizon typically is, like 3 to 6 months up to a year, and I'm trying to like make a profit over that period of time. I'm not trying to turn a profit within a week or a few days. Given that is how my trading horizon is, generally I rely on macro as a way to kind of anchor me, because I want to make sure that if I get the anchor, the macro variable right, then I think that for the most part, I can trade through any period of volatility and still do fairly well by the time my horizon kind of expires. Other people are just trying to make a buck over a few days or a day or 24 hours. So, they have a different kind of set. But if you have a medium to longer term time frame like I do, I would say macro is very important, because right now we're seeing that, based on the macro factors that we've gotten on monetary policy, this has been pressuring the dollar higher over the last 6 weeks, 2 months. And this is really what's been hurting our space. Does it always work that way? To some extent, the dollar is what we trade against for the most part for most of these currencies. So that's what I think anyone needs to kind of pay attention to. But we've seen regimes in the past where the dollar has been stronger, and Bitcoin or other crypto assets have still done well. So it's not always a permanent effect. You need to kind of look precisely of what's actually going on and why it's driving it. Right now, macro is driving it because of the government shutdown, but in weird ways. Because of the government shutdown, we haven't gotten the economic data we needed. No one's models have worked properly because we're just trading in the data vacuum. And as a result, you've had to rely on other things to kind of compensate for it. And I think consequently, we've depended a lot more on macro, but in these kind of like nebulous ways of like, well, I don't have BLS data, so I need to substitute with ADP or this or other things. And the data honestly has been telling you different things. Like for a while there, ADP was actually pointing lower, and like Bureau of Labor Statistics data was pointing higher on the jobs front. Then, of course, we got that big revision a few months ago where we're like, okay, BLS data was just completely off, and yeah, jobs were bad. So I would say that like those kinds of things do matter. We're just kind of in this regime right now where because the Fed is so important to how much liquidity is going to be unlocked, what's been happening with, and I don't think a lot of people pay attention to the nuances of this, what's been happening on the reverse repo facility, which has created strange effects on, or volatile effects on the overnight interest rates. That has also contributed to problems with a breakdown in liquidity for larger players who need to borrow in order to fund trades. So I think this is why all of a sudden macro has taken a pronounced position inside of our models and inside of the way we need to think. But it's not an always thing.
Okay, last question for you, David. You mentioned a little while ago during the show that you are a former quant. What if you were still a quant now? I guess I can't really tell the difference between like the incredible work you do now and being a full-time quant. So I want to know what that means. But what would you be? What else would you be looking at now if you were still a quant, as you put it?
Okay, what I mean by that was when I started my career, and it was 20 years ago now. For the first 5 years, I was a quant researcher, a quant strategist, which meant that I was hired on specifically to build models and think about it. But it was a very, very different world than it is today, because I will tell you that like 20 years ago, when we were thinking about what a quant, quote unquote, is in the financial world, I was doing like PCA analysis. I was just doing like simple like Black-Scholes modeling for options and trying to figure out what's the best like option structure to actually trade this stuff. So then I was kind of like looking at like, oh, all right, like is it straddle, strangles? Should I be looking at calendar plays and just kind of like throwing the whole like, kitchen sink at a problem and trying to figure out what the solution is. Today, being in quant is a very, very different world because we have the power of AI, but also like we realize now that, iteratively, like you can do more things with the tools we have. Like back then, the tools we used were Excel. Today, the tools we use are like Python and other models. So you can build a random forest feature importance charts like within an hour. Like even like 5 years ago, by the way, I built one of these like when I was like trading EM fixed income. And it took me like a week to 2 weeks to build out a full model. Now I can do it like with AI in an hour, and I'm like, yeah, that's the right code for this. Or if you want, like we're in a completely different place now, I would say. So that's kind of how I qualify quant. Like I'm much more of a macro strategist these days, by which I mean I think more about like the macro factors that are driving this. Like I don't do like a crazy analysis. Anyway, long-winded way of saying like, what am I looking at right now? At least if I was thinking about it from a quant angle, I would say that something I look at pretty heavily. I would think about the systematic leverage ratio that we have in there. Think about the open interest dominance over Bitcoin. So what I mean by that is I've looked at open interest on the altcoins versus Bitcoin open interest as a ratio to understand like where's the breaking point, because for a while there that was as high as like 1.7, and typically when it breaks that 1.2 threshold, that means like things have gotten like too frothy. And that happened, by the way, like right before October 10th happened, and that was something we had been monitoring, and then it broke it decisively, and it never really kind of came back down in a way that I felt comfortable with. And of course the deleveraging kind of happened. We're in a better place now for that, but that's definitely a key ratio that I think that people should follow up on. And again, some of the macro dynamics, M2 money supply. I think that's really important, but also digging in further because, for example, in China right now, M1 versus M2 money supply, it's very odd. Like M1 is dropping, but M2 is increasing. Typically, these things should be moving in the same direction. Why is that happening? I think digging into a lot of these concepts from a quant perspective is definitely relevant to try to figure out and unpack like what could be happening in our space.
Awesome, David. Thank you for the answer, and thank you for the background check on what your former life and how hard things used to be for the kids today. Will never appreciate how hard it was to be a quant back
My
in the
day,
Put
we
it that
used
way.
Excel and VBA. We didn't have Python packages.
Oh, that's great. All right, David, thank you for coming on the show. If you guys want to check out David, his X handle is David Duong, but where the I is a 1. So you can check him out there. And Coinbase.com/institutional is the site. Sign up to the newsletter. If you're a Coinbase One subscriber as well, you get it. You get it before everybody else. So a lot of great information there. David, we will see you again, I believe, before the end of the year, hopefully, to really dig into 2026 and what we're expecting there. So I'm keen to have you back on the show.
Yeah, I really appreciate it. Thanks so much.
If y'all are making swaps or trades right now, highly recommend you check out Milk Road Swap. This is a DEX that we built in partnership with Cow Protocol. Why did we build it? Not to make money, just honestly so we could have a place to do our swaps for the lowest fees that we could find. This is the fees on Ethereum, Arbitrum, and Base are only 0.15% fees. This is a huge difference from other centralized exchanges that charge 0.5% or even up to 1.2% fees on their swaps. Also, you can swap on Solana, all at swap.milkroad.com. Check it out today. You won't be upset. And you can join me in my favorite place to make swaps on chain. Want insights on what's moving crypto markets and how we're trading each event? Subscribe to our channel and join the Milk Road Daily and Pro newsletters and start investing like the top 1%. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.